Justin is run by a bunch of investment bankers, and Morningstar's modus operandi.
I'm Jason Stipp from Morningstar. There's no denying that the fate of the U.S. consumer and the U.S. economy are closely connected. But just how crucial is the consumer, and how is he feeling today? Here with me to offer some insights is Morningstar's Bob Johnson. He's Associate Director of Economic Analysis. Thanks for joining me, Bob.
Good to be here today.
So you recently described the effect of consumer spending as sort of a whip effect on the economy. Can you explain a little bit about what you mean by that?
Sure. It's like a giant whip or a crack the whip game, where at the handle of the whip is the consumer, and it actually doesn't move very much, but at the very tip of the whip is something like investment spending that is very, very volatile. And you might see consumer spending go down 2%, but you might see investment spending go down, as it did this time, as much as 30%. So a little move in consumer moves a lot of the other categories even more.
So certainly because the consumer is just such a huge part of the economy overall, that you can see a little improvement there, but it creates this sort of follow-on effect on the down and on the upside as well.
It goes both ways, and the consumer, as you say, is 70%. But what it really affects is the business investment spending and so forth down the other end of the whip, which really moves the economy around.
Sure. So give us a sense then of how far it seems like consumers have been improving. Recent reports showed some improvement there. How much farther do we have to go to sort of get back to normal? Have we completely recovered, or do we still have some ways to go?
Well, where we are, believe it or not, and it's a hard number to believe, and I'll break it down just a little bit, but consumer spending in real dollars, that is inflation adjusted, is higher than it's ever been in U.S. history now as of last month's report. So I think that's a pretty amazing number. We've recovered the ground we lost. Now, keep in mind, it wasn't all that much ground. It was around 2% decline in consumer spending overall, and now we've gotten every last drop of that back and a little.
Okay, and so, I think that we have seen in retail sales reports, some real spending is going on out there. Consumer wallets seem to be opening a little bit. I think that for a lot of people, they're wondering, how is this happening when unemployment still seems quite high? We've seen some improvement there, but we're still at elevated levels. Where is the money coming from?
Yeah, very good question. A couple places where it's not coming from. It's not coming from debt. The consumer debt levels are down from where they were at the worst of the recession. We've actually spent down, so the good news is that they're not spending it on from a bunch of loans. That's the good news. It would appear that a lot of the money is coming out of savings, gains that have been made in the stock market, and given that some of the higher end stores, the Nordstroms, the Saks, and so forth, have been particularly strong, might be indicative of the fact that some of it's coming out of savings and stock market returns. We are up in the 70% range in the market, and some of that money inevitably gets spent.
So we're seeing sort of a flip side of that negative wealth effect that we had in the depths of the downturn is coming back around now. People see their portfolio levels up a little bit, they feel a bit wealthier, and perhaps that leads them to spend a little more money than they hadn't been spending during the downturn.
Absolutely, and I guess the other thing I'd want to say, a lot of people are like, well, now the savings rate's going to go back to the same crummy result before, and then we're going to be in the same old problems again. And I don't really think we're there. I think when we got to 5–6% savings rate, I think that number was high because everybody was scared, really scared, and panicked, and saved more than they really needed to, if you will.
Sure.
And I think that now the number's down around 3%, so we've kind of cut it in half, but it's still off the zero that we reached at one point in time.
Okay. Well, now that we've seen, a nice pop in the stock market, and maybe that wealth effect, it probably has some end to it,
yes,
after the market has come up. And we also saw some stimulus last year that helped to spur spending in the auto area, for
yes,
example. What's it going to take to sort of keep this engine going? Do we need to see further government stimulus? Do we need to see further stock market gains? Or are there more fundamental factors that'll get consumers to continue their spending trends?
Sure. I think that the next step in the puzzle is the manufacturing component to come back, which it has, and then see them hire more people and bring the employment number up, which we're seeing, and then that leads to more service jobs around the periphery of the manufacturing businesses. And I think last month's job growth of 290,000 is indicative of what can happen, and if we get a few more months of that, that will put a lot more income in the hands of the consumer. And I think that's going to be the key driver in the next 6 months, along with more hours worked and maybe some gains in real wages.
Okay. So last question for you. It's always nice to sort of see some of these assumptions play out on the ground in some anecdotal evidence. What stories do you have from the street that indicate, that we are seeing a real recovery for the consumer?
Yeah. There's two things that are going on out there. There's a lot of things happening in the tech sector, and then there's other things happening in the restaurant sector. And those are two kind of consumer discretionary items where they're a little volatile and maybe extra, so that when people spend there, you know things are getting better.
Sure.
Well, in the case of restaurants, just to pick a name, they're all doing very well. Most of them are doing very well right now. If you look at Starbucks, if you want to pick one name brand, the traffic in their stores was up in the most recent quarter for the first time in 13 quarters. That's more than 3 years. And so that's one of the signs that's going on there. And you've got everybody from Brinker's and doing well, Cheesecake Factory and kind of the mid-cycle restaurants. And then even on the low end, McDonald's continues to do well and report great sales results. So that's the restaurant side, and that's discretionary, and that's doing well. In the tech sector, where to start? I mean, Intel's excellent earnings this quarter were largely driven by consumer spending. We've seen articles that the netbooks are beginning to lose favor, and conventional notebooks that are more expensive, more highly featured, are actually selling better. Apple Macintoshes are growing much faster than the entire industry, and yet they're 2 to 3 times the price of other computers on a list price. I mean, if you adjust it for a few things, it's not as drastic, but the Apples are more expensive, and people are flocking to them.
Certainly nice to see some of those positive signs. Bob, thanks for your context and the insight on the consumer today.
Great to be here.
For Morningstar, I'm Jason Stipp. Thanks for watching.